Okay, my name is Rob Ellis with Horizontal Land Partners, and in today's video, we're going to cover uh, a term sheet that I live in Miami, capital market. We have been raising 50 million for a general partner, limited partner, land entitlement absorbing institutional level advisory firm. Our original name was Midwest Residential Growth Partners, and now it is Horizontal Land Partners because of our desire to work in master plan communities. Sometimes we're going to have retail, we're going to have different markets. We're not just residential, we're not just Midwest. So we rebranded last month. And at this point, we're in our website. We have a capital raiser who is beginning, and we have our first deal under contract as of yesterday. So what we are doing is this is a by right RM-12 27.4 acre site. Let's see if we have a picture of it. This is the topographical. So this shows the site. It's basically this box right here, right behind the senior living, residential. It's landlocked. And we want to create two pods of residential neighborhoods. So more than likely, we're going to bring this street down here. We're going to bring that across and then do a circle here, and connect down here. So 3 entry points. And we're going to have our target is a stormwater probably over here with, again, 2 pods here, or we'll put it in between, but normally you want it to be downhill. So the first thing we're doing is this is our site locked up through options. We have 4 options. We had lots. When you raise for a fund, you have to have a track record. You have to have deals in the pipeline. Our fund is aiming to do 7 to 10 deals a year. And from all the work that it takes to get here, we would definitely like to be on larger sites, probably 80 to 100 acres, 40 acres minimum. But this one was very difficult to pass up because it is so easy. This is an RM-12 by right, utilities at the street, no floodplain, landlocked in between other developments. It's in a market that's had a full exit, Springfield. And so we're going to get into that in this video. Let's see here. What we do typically, we cover a comprehensive soils report and put it together for builders. We look at, this is what that looks like. It's 80 pages of soil. We're already talking to infrastructure. It talks about all the different soil makeups. I came from vertical markets. This is simple stuff. Putting houses on land is with no basements is easy. So we typically do that. That's the first step. And once we get site control, that's part of the preliminary zoning, utilities. Make sure it's not too difficult. Make sure the zoning is going to be good. We talked to the municipality about platting and conceptual plats. And then the next step is for us to pull plat records. We already did that. So we pulled our plats here. So we pull historical plats, reserve at Honeysuckle. This shows the densities and plat. We look at the submarkets. We talk to initial builders on interest. There's enough interest in this community. There's institutional activity, and we wait for control. We made our options offer. We got it accepted, and then we enter the market. Now, we were considering townhomes, but 90% of development is single family home detached. So there's 3 types of risk: entitlement risk, infrastructure risk, and construction and sale risk. I wouldn't even consider putting entitlement risk is the riskiest portion of it. That's why you get paid the big bucks. So our fund underwrites minimum 100% returns in 12 to 16 months. And on this site, we definitely didn't need it. We timed that up with our options offer. We have the ability. Today, we wired our initial options offer. We have site control now because we fulfilled our And so the next portion becomes what we consider a lot purchase agreement solicitation and infrastructure takedown SPV solicitation, which means how we exit as a fund. That we are the furthest upstream you can be, raw land to platting. We are taking on the entitlement risk. Once a plat is created, you have approvals, you can sell the projects. The difference between build to rent and build to sell is build to rent typically wouldn't plat, and they typically wouldn't put in infrastructure, but that is still an emerging market. By large and far, the players in the market that have the greatest pulse are the build to sell builders. And there is 10 builders that control 89% of the market in Columbus. And so we don't have that many clients. If no one would do it, we have lots of flexibility. This was an RM-12 district. We could put up to 324 townhomes on it. We decided against that. And we have a preliminary, most LPAs are confidential, but we can say who the players are. We could say there's nothing about this that is secret. There's no confidentiality clauses, and we have full site control. So this is about getting the word out about Springfield. It's about getting the word out about this site. It's about getting the word out about infrastructure, which is basically we exit to somebody that's going to put in roads, sidewalks, sewer, water, stormwater. There's national firms that do that. We look to sell to national firms with balance sheets greater than $100 million, not just in balance sheet purchasing capabilities, but also annual revenue. Typically, those match up. So that gets rid of a lot of the small business risk. We use small businesses to get it, local players. We talk to them. But from someone that's coming from a capital market doing institutional level sales for the last 5 years, I sold to national construction general contractors on projects greater than $25 million. This project is $41 million, approximately. And that's about where you need to be at. So this is as small of a site as we can get. This is barely enough for 2 pods. Typically, builders want less than or want more than at least 50. And we structured everything for an easy exit and the largest buyer pool. We have 2 conceptual platters working on it. We're testing new platters depending on the region. We give them a small allocation. We've already outlaid that and given it to them. It takes 7 to 10 days to do that. We're past conceptual platting. So the next step in the process is solicitation. Now, you can write a term sheet or they can write a term sheet. We write our drafted term sheet backed by the most data possible. And that's what we're here to do. This is our LPA submission package. This is our term sheet. This is a lot purchase agreement. Prepared by Horizontal Land Partners, Springfield Residential Development, East McCrade Avenue, Springfield, Ohio, April 24, 2025. National Regional Home Builder Review. Introduction and purpose. This document outlines the proposed lot purchase agreement structure for a 27.4 acre by right RM-12 zoned infill site located in Springfield, Ohio. It's controlled by Horizontal Land Partners pursuant to an executive site control agreement dated April 23rd, 2025, yesterday. That's how efficient we are. The development strategy includes phase delivery of 134 finished lots across 2 product types over a maximum 36-month absorption period. Pricing is milestone driven, fixed with an annual cap, and positioned below market appreciation trends to support builder feasibility and absorption velocity. One of the things we've done is we value the project. We look at how much projects increase based on resale activity. There's only 2 or 3 subdivisions that have occurred, and we say that upside is all yours if you take down the site quickly. Location, Springfield, Ohio, with direct access to I-70, US 42, State Route 41, and State Route 4. Approximately 29 minutes to Dayton, 48 minutes to Columbus, 1 hour and 16 minutes to Cincinnati. We call that kind of that triangle a very, very sweet spot. All the builders are willing to go in that little triangle. The Ohio Triangle, we're going to start it out. There's something called the Texas Triangle, and we're going to start the Ohio Triangle. How's that? Zoning RM-12, 12 units per acre by right. No rezoning, no agricultural stuff, no tips, no nothing. This is as easy as it gets for these guys. This is super fast by right development. That's why we took this site down. Utilities are available at the frontage and civil ready. Builder market analysis. Who are the players and how many active subdivisions do they have in central Ohio? MI Homes has 20, 350 to 760. Ryan Homes, 290 to 360. Pulte and Syntex have more than 30, but they're not active in the Dayton area. So they're on average 350 to 450. Miranda Homes has multiple. They are also active in the market, 340 to 470. Arbor Homes, 5 plus, 285 to 590. Clayton Properties Group is emerging with takedowns in this market in Bell Fountain. They're buying out of Indiana where their mailing address is. And typically what we'll do is we'll take a hard copy of this, print it out, and mail it out first class to these 10 builders' corporate offices for them to review. Straight to the mailing addresses. They buy lots in these markets. They're already active in Springfield. Fisher Homes, 20 plus, 400 to 530, active in Dayton. Rockford Homes, emerging, not active. Over 85% of new construction within Clark County, including recent plats, is single family homes detached with pricing targeting under 400,000. That's the site. That is the site and market submarket analysis and the active players. How many builders is that? 1, 2, 3, 4, 5, 6, 7, 8. We have 8 potential build to sell players that are already, we have another probably 8 to 10 if we wanted to that we could put this out to, but it's great to start with the players. Everybody considers Springfield differently. Some it's in the Columbus market, some it's in the Dayton market, some they don't have a presence at all. Over 85% of new housing in Clark County submarkets is single family detached. We already read that. Site configuration and yield strategy. Now, we talked to this, and there are groups that are willing to take down whole sites, but they want to phase it over. We do not allow phasing. This is full builder takedowns and pod arrangements master planned for that are master planned. And we listen to our builder partners, and they say we don't want to compete in competing product classes. That's exactly the point here. So that means that we can have 2 separate builders or one builder that starts 2 segments. The pod lot sizes, 45 by 135, 55 by 135. We have a little bit more entry level. That's for 250 to 325. And then we have a secondary, a B pod that's 55 to 135 for 60 lots. Traditionally, you would see 50 as a minimum. Those will be separated out, not together, right? They can name them whatever they want. They can name the streets whatever they want. We haven't done any of that stuff. I could care less what we call it. We have a total gross area of net 895,158 square feet after roadways, stormwater. Minimum commitments is 50 lots per builder or builder group. Dual segmentation is enabled via separate physical pod configuration. These aren't blended together. The streets don't run in. We are what Ohio is looking for, which is a national land entitlement and development advisory firm that is entering the market with data-backed decision-making reporting. Milestone takedown structures. This is what we're proposing for our projects. Milestone final plat approval, 10%. Jurisdictional plat recording completed. Grading completion. Mass grading and erosion control complete, 15%. Underground utility completion, 25%. Sewer water storms installed and pressure tested. Pavement curb installation. Pavement and curb, 25%. Road base, asphalt, curb, and ADA. In this case, it's public. It's going to be concrete. These are public. So completion of infrastructure, certificate of infrastructure completion, engineer certified Infrastructure readiness, 25%. Each milestone triggers a lot release. Builders shall close within 30 days of notice. Pricing escalation is capped at 2% on unreleased lots. We're capped on our pricing structure for inflation because we want fast takedowns. And for our first deal, we want to get it done quick. Okay. We're pricing this at our minimum hurdle for our fund, which is 100%. And we have price escalations that describe it. So we're getting into the lot pricing. 74 lots at $61,000, $4.5 million. And that is one segment they can take, and the other one is 60 lots at $64,000, $3.840 million. That's 134 lots, 8.354. We are capping this with at 18% of what new construction homes can sell for. Land to home ratio of 18%, significantly under historical maximums, which are exceeding 20% in this submarket. We can back it by data. At a market standard 5% land appreciation rate, we're seeing higher. We're pushing all of the upside to the builders. Builder upside is estimated at $96.15 per lot over 3 years, a 15.76 margin benefit, representing institutional level grade risk insulation. And we have more to go. Market-based sale comps. Bridgewater phase 3. NVR, purchase a piece of land for $52,000. Phase 3 baseline lot acquisition. Bridgewater phase 4, $58,000. That shows the escalation even within what you can see is 4 months. A 4,000 or almost a 10% increase in just 4 months. The end buyer bought that for $257, 3-month turns, 1,700, RM-12 zoning, just like ours, 20.3% land to home ratio. Bridgewater phase 2, 58,000 sold for 359, 16.2 land to home appreciation ratio. We're showing the ranges. That was in the same 7-month period. 257 to 359 is the range. We're showing that. Okay. We're also showing the uplift of the project, which shows that this project every year will hit that target of where they're coming. So if a builder enters now on a 3-year takedown, they are securing their position substantially on a massive project. Okay. Another one, Clayton Properties bought $800,000 last year, $57,000 per lot. And then we have some larger lots already transacting. That is as recent as this year, 67,000 R500 oversized suburban lot comp. Okay. Value prop, institutional pricing discipline with submarket variables data, no speculative uplift, velocity focused takedown strategies, 3-year fixed schedule with milestone-based closings and capped annual escalators. Pricing structure designed to preserve builder margin below market inflation trends. Dual segmentation enables simultaneous product line deployment without internal competition. Execution team. Horizontal land partners has land control, entitlement, and builder coordination. If we self-perform the infrastructure, that'll be under my sister company, Pink Development. Civil oversight, horizontal infrastructure execution through qualified subcontractors that have institutional level installation experience in national or regional builder subdivisions within 60 miles. The next steps is to confirm pod configuration or allocation and builder intent, submit conceptual plat for review and engineering, and execute formal LPV inclusive of pricing schedule and milestone framework. This is by far the strongest data that we could have. Exhibit A, value uplift precedent, Bridgewater phase 1. Horizontal land partners, project reference, Springfield, Ohio, parcel ID, Tuttle Road, Springfield, Ohio. It was in Clark Shawnee LSD, 30-year Bridgewater TIF, 5,300 square foot lot with the RM-12 platted lot, same as ours. Exhibit A is lot uplift, home appreciation, and it's within the RM-12 that. Bridgewater Phase 1 is a strong local precedent for value creation and entry-level home absorption. The following case studies illustrate lot-to-home conversion economics, demonstrating clear market support for finished lot values between $60,000 and $64,000. Additionally, this exhibit introduces a framework for evaluating total project uplift and value creation per housing unit per year. Case study. Here's that house. It's a 2-story colonial, 1,600, sold in 2020 for $246,000. The lot was purchased at $46,000. That's 18.7%. Raw to improved uplift is 5.35. Home appreciation of 1.5 years is $24,000. Resale for $270,000. Just slightly later. That's the basis for our new construction home appreciation. We have a secondary comp here, 214 South Tuttle. That's also in phase 1. 2-story colonial, 4 beds, 2 baths, 2,200. Priced at $221, sold in December 2020, probably one of the first, and it resold for $300,000. That shows 20% land to home ratio, 4.8% raw to improved uplift, home appreciation over 4 years, 78,000, 35.4%, which is 19,000 per year. Up here, it's a little bit less than that, but we're showing the blended average of 2 comps that have now come full cycle. Total project value framework. Current phase. We're valuing each home at $346,000. 18% of the projected value is $8.34. Proposed pricing is $60,000 to $64,000 per unit static with a insulation, with a inflation rider for 2% appreciation at $46 million. Now, what we see there is the blended at 7%. This is what you're seeing, that the housing unit's going to go from 373 to 401 to 430 and to continue to go. So just sitting on this project and starting and slowly building them shows how much you stand to make. The net gain, it shows the uplift, 4.5 million, 2.7 million, 3.9 million, depending on the house. And you're going to see more that comes down in our pricing assumptions, and it shows the total uplift, which is 11 million. So if you build all the home spec, this shows how much your value improves every single year that you can underwrite. Cumulative appreciation over 3 years is 24%, $11 million increase. Per unit uplift is $83,000 a home, but lot price remains fixed. That's $60,000 to $64,000 builder gain. The price justification is historical resale validates finished lot pricings. We already see them at $60,000 in the market, including these types. The last NVR in 2024, their last sellout, they sold it out in 4 years. We schedule these out much shorter for our infrastructure and partners with caps on the longest duration. They can take down the whole site and buy it all right now and build it all out. They can do it however they want, but if they want to do a tiered structure, they can. The builder incentive is fixed lot pricing, passes total appreciation benefit to the builders. Continued home appreciation and resale velocity supports new phase absorption. So if they bought them both to the lower end and then the higher end, they can phase it through segmentation as well. They have to buy the lots, but they can sit on them. Execution risk. Infill site with utilities, no annexation, and buy rate zoning. It says this exhibit serves to validate premium lot pricing in current LPA negotiations and highlights builder upside from historical resale uplift and forecasted project-wide appreciation within the Bridgewater framework. No brainer. Exhibit B, Clayton properties. This is very similar. Value uplift is the secondary comp, Northridge subdivision. They buy and take down sites much smaller. You see how they buy it 12 parcels a quarter, probably. Bulk land sale. They like to buy them in packages, but I've seen that purchase as high as $2.5 million. Springfield, Ohio, Northridge Subdivision, Burton Drive, Northeastern LSD, 8,000 RM-12 platted lot. Harris Clayton Properties Group bought it from RM Harris, and probably they were sitting on it. Clayton Properties Group, Nathan and Alexandra Mays bought it for $299, and later it sold for $333. Built in 2023, Colonial 2-bed, 4-bed, 2.5 bath, $23.90. We see that higher home sell for less, but depending on your strategy, it's important to have multiple types. So electric and heat pump, aluminum and vinyl, basement, none. And some up here as well. When you look at these, the comps that they're building are, I don't think it said on our other one. I didn't put whether it had a basement or not. But the valuation summary shows 11% appreciation over 14 months, 33,000. Talk about how to make money. Own a new house. Buy a new house and sit on it. Annual property taxes, 1.5%, no TIF or special assessments. It demonstrates rapid year-over-year new home appreciation and infill Springfield. Strong resale supports Clayton Properties infill product positioning for future pod allocations. Highlights demand strength for entry-level slab on grade 4 bedrooms. Supports lot values 45,000 and end home comfortably in the 300 to 350 range. When they bought this here, it was 45 on 299,000, which is closer to the 15 to 20% range that we see more consistently in emerging markets. What this means is also that, let's see here. Reinforces builder appetite and market availability for no TIF, utility served by right development sites. Supports lot values at 45K. This is prepared for use as a secondary comp and Springfield LPA building materials to support $60,000 to $64,000 lot pricing and builder pod segmentation. This shows two different builder takedowns. These are much quicker. This shows how fast they transferred it. Let's see where the transfers was. That was 8 months. NVR is pre-selling these. Neither of these groups even use the MLS, which is nuts. We're seeing higher valuations for firms that do. Which these firms specialize in being early movers and having internal sales teams and lower sale comps. They are machines when it comes to that. That is up to them on how to do the strategy. So what do we do with that? That shows our builders what we're doing. Included in the package is also this, which is our infrastructure developer term sheet. We are entitlement risk. We try to hit our hurdle as quickly as possible. And we love making new connections with infrastructure teams. So cover memo to builder partners. Infrastructure delivery and lot commitments readiness prepared by horizontal land partners. This memo accompanies our full infrastructure term sheet to provide clarity and confidence in our development execution strategy. Horizontal Land Partners has fully secured site control and intends to transition this Springfield, Ohio project into a finished shovel-ready subdivision via a double close into a dedicated SPV. All entitlement risk is retained by our team upon plat recording and LPA execution. Infrastructure will be delivered through a non-recourse improvement structure. We have designed a project for flexibility and certainty. Builder takedowns may occur over 18 to 36 months, depending on market velocity. All lots are fully segmented by pod and price. Absorption sequencing has been designed to avoid internal competition between builders. We welcome early segmentation and LPL structuring to accommodate product variation. This term sheet outlines our total development basis, takedown structures, and infrastructure delivery framework. It ensures your lots will be delivered on time at predictable costs and without requiring your team to underwrite infrastructure risk. We are proud to share this execution roadmap in tandem with your LPA for internal review. Please don't hesitate to reach out with structuring requests or timeline discussions. And here is what it looks like. Infrastructure developer term sheet, Springfield 134 lot, RM-12 zone site, April 2025. Target purchases include infrastructure developers with $100 million in annual revenue and a national or regional footprint. Qualified candidates include firms such as Four Star Group. They're actually not a subsidiary. They kind of are, but they're public. Walton Global, Ashton Woods Land, Sam Rogers Infrastructure, Gen Land, and 5 Point Holdings. These groups specialize in horizontal land development, structured SPV acquisition, and long-term delivery of entitled residential infrastructure. It's our job to pass this on to a low-risk infrastructure partner that has a balance sheet to take these down. We are not interested. We can, but we're not interested. This offering represents a shovel-ready infrastructure development opportunity for a 134-lot by-right residential subdivision located in Springfield, Ohio. Horizontal Land Partners seeks to transition the project post-entitlement and post-builder commitment into an SPV under infrastructure development risk. The offering includes full entitlement, jurisdictional platting, and secured LPA agreements with regional and national builders with large balance sheets. This infrastructure scope includes installation of public right-of-way streets, curbs, sidewalks, stormwater, sanitary sewer, and water systems totaling approximately $3 to $4 million in non-recourse improvements post-platted land acquisition. 134, target land sale price, $1.65 million. Estimated infrastructure budget. The 1.65 allows us to hit our hurdle, pay for entitlements, and reach a 100% underwritten in 12 months or less. And we're drafting this on day 2. We have 364 days to find a buyer. The estimated infrastructure budget based on 2 different benchmarks. Early level, $3.135 million. Total developer basis, 4.785. Total builder LPA, 8.354. Projected gross margin, 3.65 million. IRR levered over 36 months. Max, 29.1%. Absorption range, 18 to 36 months. It talks about the site, 27 acres gross, 20.5 acres net plattable after right-of-way and open space. Planned lots is 134, 74 at 45, and 60 at 55. Average lot size is 6750. Total project LPA agreement value is 8.34. Infrastructure development terms, acquisition price and exit schedule. Target sale price minimum 1.65. It represents Horizontal Land Partners hurdle rate and some minimum valuation for a full project sale into an SPV. Exit timeline, full site exit within 12 months of plat recording via a double close into an infrastructure controlled SPV. Horizontal Land Partners position retains all entitlement risk and seeks to transition in infrastructure risk upon plat approval. Infrastructure developers purchasing the project inherit all builder LPAs and associated revenue streams. Projected sale price escalations. This is if they don't buy it in the first 3 months. July 2025, 10%, 1.815 million. October, 10% price bump, 1.997 million. January 2026, 2.197 million. And the ceiling is 2.2. April 2026. Use of proceeds may be applied toward lot acquisitions, entitlement spend, civil platting, LPA execution, and other soft costs. Horizontal Land Partners support to close on the site contemporaneously with the infrastructure developer's early commitment. If the developer agrees to fund entitlements, which are up to $200,000, an early purchase contract will be executed. HLP will transfer lots into an SPV, eliminating entitlement exposure and deferring profit realization until platting and subsequent closing on non-recourse infrastructure improvements. All infrastructure improvements post-platting are expected to be financed on non-recourse basis, not from us, but another equity group. Entitlement and civil status. Entitlement status is by right, no rezoning, civil engineering to be executed immediately post-conceptual approval, target of 90 days or less. Platting timeline, record ready within 120 days. Infrastructure cost. Here's how we priced it. $22,000 a lot, 2.926 is one. Alternate is per linear foot. Based on double stack roads, 4,281, 1,000. Midpoint average is 3.13. Developer return model, projected resale, 8.354. Infrastructure and land basis, 1.65 million on the land, 3.13 million on the development. Implied gross profit, 3.569 million. Sample leverage model, capital required 1.1 to close. Cost of capital 7%, 3-year term. Levered return 29.1% IRR based on a 3-year sale velocity, which will only go up. It shows a lot pricing, 74 lots at 61,000, 60 lots at 64,000, and the total blended of 8.354 million. It shows the milestone-based takedowns that they'll absorb. Final plat approval, 10%. Jurisdictional plat recording completed. Grading completion, 15%. Mass grading, erosion control complete. Underground utility completion, 25%. Sewer, water, and storm systems installed. Pavement and curb installation, 25%. Road-based asphalt, which is actually concrete, depending on what we hear back, but it's just a standard. This is a standard template. Curb and ADA ramps completed. Completion of certificate of completion, engineer certified infrastructure readiness, another 25%. Income stream model. Builder LPA commitments with fixed pricing segmented by product line. Takedown velocity is 4 to 8 lots per month per segmentation. 16 to 18 month absorption window at the fastest, but they have flexibility up to 36 months. Multiple national, public, and regional builders. Ryan Homes, D.R. Horton, Arbor, Miranda, etc. LP agreements are tied to shovel-ready plat. Commitment to be finalized before infrastructure mobilization. Absorption, flexibility. Builder partners have requested and been granted a flexible takedown schedule due to the nature of the submarket. It's a newer entry. It's not mature. These are regional builders entering the market after some of the early movers, Clayton, NDR. You already see D.R. Horton and Arbor in here, and now other firms are ready to go. Up to 36 months for full builder absorption. Quality revenue release estimate based on 33% takedown per quarter. Post-platting, gross revenues to infrastructure developer are projected at 2.76 million per quarter over three quarters, subject to LPA schedule adherence with our contact terms. Okay. The last part of this submission package is the builder LPA email. And this is what we say. We've secured full site control on a 134 lot RM-12 zone subdivision in Springfield, a strategically positioned submarket benefiting from increasing builder absorption, strong rental demand, and favorable entitlement timelines. Platting is underway with an expected recordation in the next 6 months. We're currently seeking early LPA commitments that will guide pod segmentation, takedown velocity, and directly inform our infrastructure partner engagement. We are absorbing all entitlement risk and will deliver building-ready lots via a non-recourse horizontal development structure. Attached for your review are 2 coordinated documents: an LPA term sheet, lot pricing, milestone-based release schedule, and absorption flexibility, 18 to 36 months. Infrastructure term sheet outlines post-plat SPV delivery, builder segmentation, and price escalation mechanics. We're asking your team to review and advise on LPA readiness and ability to commit in the near term, pre-plat or post-plat, lot signing and product alignment across pods A and B, lot sizing and product alignment, preferred infrastructure operators, or whether you're open to sharing this with internal partners. Once we secure initial builder alignment, we will finalize infrastructure structuring to support phase lot delivery without delay. Commitments now allow us to preserve pricing and advance civil coordination on your behalf at no cost. Part of our entitlement risk. We'd appreciate your chance to walk through these materials with you. Would you be available this week or next for a quick call to review? Looking forward to the conversation. Best regards, Rob Ellis, principal at Horizontal Land Partners. That's it. So what we do, we distribute this among builders. We gauge interest. We can also sell the project to an infrastructure developer, those are 3 to 5 more people that we show that we could sell it to. But first we have to secure LPAs, and we're looking at the drawdowns. We do not want 5-year phasing. This is a small development. You saw Bridgewater, 226 units sold out in 4 years. that is absorption of 5 a month, which is actually more than 5 a month. Yeah, it's about 5 a month. 56 homes a year. So this is a 2-year absorption window. There's no reason they can't buy these and move on, but it gives them flexibility. With that, we will submit it. I hope you guys enjoyed the video. And this is to show you that we are featuring, I'm based in Miami. It's a capital market. We are active in Ohio, Columbus, Ohio, Cincinnati. This is one of the fastest blow up markets still available. Columbus is the fastest growing city in the Midwest by millennials. It's the fastest growing jobs market in the Midwest. It's the fastest growing market in the Midwest by general population as well. So there is massive interest. You can see the resale, the unbelievable resale comps, $30,000 gains a month, especially in this price point, is just unbelievable. This is the largest uplift, the 250 to 500. The average new build in our market is 505 in Columbus. And this is some of the closest submarkets that are available. This is a no-brainer for a builder. I am confident. I would have to be stupid not to be able to secure with these 3 instruments in our context. If I can't secure that, I would have to be stupid. So we're going to send this out and we're going to get feedback. And that's the whole point. Now, we do business in a lot of different manners, over the phone, email, through LinkedIn contacts. There's a lot. And so we continue to publish articles and we continue to get the word out about our developments. Miami in particular saw over deliveries, overbuilding without proper development. So in my opinion, sites between 10 and 40 acres are really meant for straight horizontal with segmentation. You can see that we can segment every 10 acres about 50 to 60 lots. We have 27 here. And this also goes to our conceptual platting teams as well. So we give this back to them. We say, hey, look, we need to entitle for non-townhome products, and we'd like to see what you can deliver, and we'd like to turn that in. At the end of the day, we give them examples of the last 5 plats, and we turn that in, and then we will start pushing for civil engineering estimates once we have a concept, and same with our builder teams. Our goal is to tighten it up to the 2 or 3 firms that are most interested and go from there. So even if they say no, it doesn't hurt to send this out. It's great press. And once we have a commitment, there is no requirement for us to, there's no rezoning, there's no public hearings. Let me just show you in case you don't understand all of, I came from the vertical markets and this is way easier. Columbus, Ohio is one of the worst places to try to develop because of the area commissions. They give precedent. We tried to dissolve that. They would not allow us. And the weights and strengths they give to area commissions, they need to be dissolved. And before we ever come back. So we do infill by right development. If I just go here and I say, if I have a by right development for RM-12, do I need to do any public hearings? Or I can go straight to engineering submission. By right, and we meet all dimensional density and use without needing variances, you generally do not need any public hearings. You can proceed straight to site plan. No public hearings if we have under the density, the setbacks, frontage, parking height, and are all met. Internal road rates comply with subdivision regulation. Utilities and stormwaters are being handled to code. We will still need administrative site plan review, which we don't have. Preliminary and final plat approval for subdivisions through a planning commission, but still administrative if by right. civil engineering submission for stormwater, utility, and street design. We have two. I have a civil engineering do a concept that we paid. Our allocation for that is less than $1,000. And we have a urban planner that we paid $1,000. Each one is going to be different. We're excited to see the quality of both, and we'll go from there. They both have the same comp sets. Building permits once lots are created and infrastructure is approved. Sometimes they'll want a traffic study, environmental or wetlands, tree preservation plan, HOA. In Springfield, we want public streets. Here's your streamlined path. Pre-application meeting, optional but smart. Planning and engineering and utility staff. We already confirmed the density and right-of-way widths. We've already done all that. Submit initial layouts. Ensure roads conform. Get preliminary feedback. Preliminary plat review. Administrative planning or planning commission. Still not a hearing. It's docketed unless you're requesting exceptions. Engineering submission. It shows the plat drawing, right-of-way dedications, utility layouts, stormwater, preliminary design, traffic, and grading. Now, these are very low residential extensions. This site is phenomenal. Engineering submissions, which we want to go straight to. Final road design, utilities, stormwater, street lights, which aren't going to be required. Stormwater, detention, final plat for recordation, city, county, planning commission, and that. Permit to construct once bonds or financial guarantees for street storm contractor begins infrastructure build per approved civil plans. So we want to get to permit. There's platting and right-of-way permits. And then you have 50 feet's the minimum. Public streets means city, county will take over long-term, but they require full compliance with local specs. Subdivision bond or LOC, letter of credit to guarantee completion of improvements. Okay, which is great. Now, that's probably outside of ours, but we'll price that as part of our package and submit it. So we have substantial amounts of information on this site already. We are now ready to circulate this, and we will go from there. I hope you guys enjoyed it. I hope you guys this helps you understand it. And for us at Horizontal Land Partners, which we have our 2-pager in our deck, this says horizontal development platform, acquire raw land in high growth markets, entitle and plat it for single family homes, and exit before vertical by selling paper lots to institutional housing buyers. That's exactly what we're after. Underwrites for 100% IRR, 2 to 3 equity multiples. We have no debt. We have no bonds, nothing. So it shows where we're focused on entry-level housing only, high growth regions, tier 1 and tier 2 metros, Sun Belts and other ones. It shows entry-level housing in high growth areas. HLP focuses on detached, buy right, deepest demand, rapid absorption, no condos or townhomes are pursued, which is exactly what we just said. Even though we still looked at it, engaged interest, because we could have pushed our lot sales by about 2 million. Didn't have it. By delivering build-ready lots, HLP taps into surging demand, Texas, Florida, Carolinas, and other high-growth areas. We're in the Midwest. I came from that, and we have some of the lowest land bases that are possible. Targeting tier 1 and tier 2 metros and suburban markets. This talks about it. Some of the large players. It talks about the different share classes. It talks about social impact and hospitality markets. It shows the most recent $800 million of a master plan community. It talks about the most successful one, and it shows my team, me, the Entitlement Development Director, and Ken, our Director of Capital Markets and Investor Relations. And we're going to go through our quick criteria. Land basis up to 70,000. This is under that. This is around 20,000. Lot densities of 0.06 to 0.25 and 4 to 12. It's both of those. This is 0.15 right in the middle. Entry-level housing. 4 to 12 an acre. Lot dimensions, 40, 50, and 60s. Ours complies with that. In depths, 120 to 130, 135. We just went through it. Sizes, 40 to 500. We don't want a large one. Now, we're under this, but it's because it's such a fast velocity buy right. That's why we went through it. But typically, we want a little more because project sizes this small barely make us $1 million. Okay. The preferred carve-outs are 100 to 200 unit single-family residential communities, which is what we have. This is 134. Out parcel strategy, front lots for retail civic. If it calls for it, this one doesn't. Entitlement budgets of 250 to 500. Based on verified third-party bids, we're going to be well under that. Max all-in allocation, 3 million. Ours is this one won't even be $800,000. Maybe $900,000. Modeled exit value, 8 to 10 million. This is under that. With the infrastructure, it's 8 million. So we could, on this site, we could stretch our returns and double them if we perform, which in my home market, we have a sister company, we can self-perform, or we can sell the development. Paper lots of 20 to 30K at 20,104. We would be selling at around, on this site, we have to be a little more flexible because it's very, 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 very entry level. It's just the right time when we see other builder activity in the market. We wouldn't go and enter a new market, too risky. Pad ready, 60 to 110. We're at 62,000. Track sales, takedowns of 2 to 5 million. We just broke that out. 4 and 3, or a little bit around that, 4.5 and 3. 25 to 50 lots per buyer to de-risk. Full site sales reserved for BTR or infrastructure. That's larger tract. So if we have 80 acres and we can sell out and hit our hurdle, we can bank. Our returns go way higher the more land we have and the more people that we can use and the better the submarket. Entire communities are fully platted for optionality and liquidity. This shows the target markets: Phoenix, Dallas, and Fort Worth, Atlanta, Tampa, Orlando, Columbus, Charlotte, San Antonio, Austin, Texas, Nashville, and Jacksonville. Columbus is the only city in the entire Midwest. And again, that's why we like this community. It is not Dayton, in our opinion, and it is not Columbus. And I'll show you that. There's a company called Borer Properties. They entered Melody Parks. They're doing tips and they're dragging it out. 40 Partners is a JV between Borer and Dillon Corp, two premier community-centric development companies. Greater Springfield, it's a PUD. So they have to rezone agricultural. They have to go through it. This is the largest that we would ever do. That is a massive exposure and probably way too large from our underwriting, way too risky to go to Springfield and buy 400 acres. I have no idea who's running their development firm, but I would not agree with that. The civil engineering, Manick Smith, GC is Borer, developers Borer, and the location is Springfield, Ohio, 400 acres, conveniently located off of, we can look at, so let's look at Melody Park. We're looking for an address. They have a contact us form. It's been a year. Ours will not be a year. We can get this done in 4 months at the fastest. Let's see here. This started back in 2022. That's how slow they're moving. Laying the groundwork. Largest Greater Springfield Partnership, a nonprofit, has been stewarding hosting developments, workforce housing, cyclical, Melody Parks. rezoning, sale of the land, and demolition. That's a lot. We don't do that kind of stuff. Assembly. Assembly. Wow. Not for us. Raw land is what we do. Infrastructure, utilities, water lines, and sewers. Finish in early 2024. Enter construction phase in the summer of 2024. Let's see if we can find it on the maps. Melody Parks, Columbus, or Springfield, Ohio. It says it's at 4100 Troy Road. Let's see where they're at. Okay, so this is how far out they are. And you see some stuff in Northridge. You see a lot of people coming in. South Charleston's got a big thing, but we like to be closer to the highways and a lot of them too. New Carlisle, there's a lot of annexations. These are very complex and complicated projects. We are right in here. How's that for competitive? We're closer to transit. We're closer to macroeconomic drivers. We're closer to a lot of things. And so because of that, we believe that it's a little bit better to do buy right. We're in the overlays, which is just incredible. You never see that. That's everything.